Hello, thank you for joining us for part 3 of this special training series collaboration between the National Good Food Network and Farm Credit. My name is Jeff Farbman from the Wallace Center at Winrock International. This special series is designed for food hubs and related businesses to take control of their finances using accurate industry standard practices. Once these skills are put into practice, operators are able to make better informed and therefore smarter operational decisions. This is the third part of the 5-part series. Today, our presenters, Erin Pirro and Gary Madison, will turn their sights on exploring the income statement, also known as the profit and loss statement. I want to remind you that on Thursday, in 2 days, there will be a full hour with Gary and Erin to directly answer your specific questions. We're framing this as an office hours section. There will be little or no formal presentation during that time. It's really meant to make sure that you fully understand all concepts and implementation details so that after this series, you'll be ready to manage your hub using these critical financial reports. The first office hours section really dug deep on some of the topics. We ran that on last Thursday, making sure that the concepts were most easily applied to the businesses that you all are working on, food hubs and the like. So today and tomorrow, please think about and start to try to implement the ideas in this webinar and bring your questions on Thursday. Our next lecture session is next week on Tuesday. And again, office hours will follow that. So if you have questions today, I want to point out that over in the control panel is the questions box. We're going to have a short question and answer section at the end of this webinar. So please use the question box to type in your questions for our presenters. We are recording and archiving this webinar on the website, including links to slides, and also on the page there is all the other archived webinars in this series. And that's up there at the top of your screen, ngfn.org/hubfinances. There'll be a link from that page to the recordings. And please complete our post-webinar survey. It takes a short time and helps us to continue to improve our webinars, including within this series. Today, I'm going to let Erin and Gary jump right in. If you'd like to hear their bio, please review the recording of the first webinar in this series. And it's also posted right there on the webinar archive page. And you can get the recordings, again, slides, recordings, bios, linked to from ngfn.org/hubfinances. Okay, let's dig into the income statement.
All right, thank you, Jeff. So good afternoon and good morning, depending on where you are. Today we're going to take a look at the income statement, which, as Jeff said, is also known as the profit and loss statement, because both of those things do happen. There are sometimes profits and there are sometimes losses. But the good news is that working with a good management chart of accounts, you can plan and you control a lot of those things a lot better than your peers. One of the things that we often see with food hub businesses and small businesses in general is that most folks track their income as sales, subtract their expenses, and then whatever's left over is profit. I don't know about you, but I work way too hard to settle for whatever's left over at the end to be my paycheck. So learning how to plan for that profit really helps make sure that it happens. And one of the ways we do that is by dividing our expenses into a couple of different categories. We still have sales at the top and profit at the bottom, but if we look at our expenses as cost of goods sold, or those that vary with the amount of production or business that we do, we can get a very clear picture of how our business operates, because we can look at those separately from the overhead expenses, or those that don't change at all, no matter the volume of business that we conduct. Now, in between, this also gives us a measure called gross margin, which is simply a measure of efficiency of how good a job we're doing at turning our input into sales dollars. And when we do a good job with that, or we know what these costs are in these different categories, we can make better decisions about what to do next with our business. You can get better or you can get bigger, but if you get better first, everything else is going to flow a whole lot easier, and you'll earn more profit to be able to accomplish your mission.
Okay, so in the end, it's not all about profit. I understand that food hubs are driven by a mission, and that's entirely laudable. But if you can't keep up with profit, if you can't plan on making some money in the operation of your food hub, then you can't keep doing it. You cannot depend on somebody funding losses year after year. And of course, profit's not a bad thing in and of itself. Probably the most important part of it is it allows you to get some return on all the effort you're putting in, even if it's only a pizza and beer party for employees once a year. But you've got to think about what profits enable you to do for the future of your food hub, and that would include equipment updates and building updates, expanding the business, and even thinking in terms of generational transfers or selling the food hub business to another operator after you've finished with it or want to pass it on. That can't be done unless that business is making a profit. Who's going to want to buy a business that is losing money year after year? So thinking in terms of profit, even if you're organized as a nonprofit, is extremely important. Nonprofit just means how you distribute those profits. It doesn't mean you're not supposed to make a profit.
Right, because you too need to think about saving for a rainy day or for retirement. Right? You need to think about paying loans back. They're not an income when you borrow them, so they're not an expense when you pay them back. You need profits to do that. Right? We've all had those jobs where the place looks like the paint is peeling and the lights aren't necessarily on because we're trying to save money, and that's not a fun place to work. We want to know that we have the resources to be able to do a good job and enjoy what we do along the way. And at the end of the day, you as the manager, if you're not getting paid, well, you're probably going to want to find something else to do eventually. And even if you love what you do, you still have a few staples that you need to buy with money. You can't grow it all yourself. So you're going to need some profit too.
So part of the exercise of these webinars is to familiarize food hub operators with the chart of accounts that is posted on the resource page on the NGFN website in order to familiarize yourselves with that chart of accounts and see how closely you can align the way that you do your accounting to that chart of accounts. And the long-range reason is if you can align to this chart of accounts that we're suggesting that you use, then you'll be able to benefit the most from the benchmarking information that we would collect from many food hubs and then present back to your food hub so as to be able to know, so you can know what your standards are, what the goals are, what you're trying to meet. So in this, go ahead, Erin.
It also helps when you're forecasting. If you're going to add on a new enterprise or add on a new building or a new delivery truck, what's going to help you cover that? Helps you know if operations are on target. So are you proceeding according to plan, or do we need to step it up in a couple of different areas? One of the things we always see is that there's a temptation to cut price, especially when there's perishable products. But certainly you want to get some money out of it. But if you constantly find yourself in that position, that may be an area you want to look a little bit further into so you don't constantly end up having to make that decision. All right.
So what we're suggesting is that if you're using the chart of accounts that we're recommending, that you also are able to extract this 5-line income statement that's very simple, that allows you to follow that basic formula of sales minus cost of goods or production, cost of goods or production equals gross margin minus overhead equals net income or net margin, net profit. You can see here that these are expressed in terms of percentages, and that these are actual results from the Food Hub benchmarking study. If you can create this for this chart right here, this 5-line income statement for your food hub, then you'll be able to immediately see how you compare with other food hubs.
Now, when we start to look at this income statement, sales are at the top, so that's one of the great places to start. When we look at income, we don't want to have it just in one big category, but think about what different departments you have within the hub. Right? So are you working with proteins and produce? They're going to contribute differently to the bottom line, so it would be important to know what they do each individually. If you have a processing component, meaning you take in product and process it for your customers, that's a different channel as well that you'll want to look at. And you'll also want to look at that miscellaneous income if you get paid for delivery or trucking, or if you charge membership fees. But notice that those are sidelines to the main event. So they don't all necessarily need their own main income category, but would be recognized with subcategories. You also want to keep an eye on discounts and returns and make sure they're applied against the department for which they actually happen. Because if you discount something by 10%, it would be really handy to know that's not income you received for that particular department. That's why your margin is low. When you have it on a whole business basis, it's really hard to tell what it's impacting. And a good guideline when you start looking at breaking down these departments is that if something is 10% or more of your sales, it's probably worth looking at on its own. You may also consider that an up-and-coming department, something that you really want to keep an eye on, would get its own category because it's that important to you. Like I said, it's just a guideline, but it's a good place to start.
So a note on terminology here. We're refining our label of cost of goods sold, which generally refers to product that you would buy from farmers to resell. We've added another label to also call it cost of production. If your food hub actually grows some vegetables for sale, you can consider growing costs like seeds and fertilizer separately from the vegetables that you would buy from farmers. And as a further refinement, we've also added selling costs, which would be the labor costs of your sales force. If your food hub doesn't grow vegetables, you can ignore the idea of cost of production. However, we'll see a little later on that it's a good idea to track selling costs separately. Now, tracking your costs is always important, but there's a deeper level of information available if you conscientiously track sales so that you can directly relate the cost of goods sold to sales categories, as Erin's been saying. One of the hardest things to track is labor costs for a particular product, such as produce that you buy in but then have to sort through and pick off leaves or add additional labor in some way. That's a second or third order way to track your labor costs and isn't necessary to do up front, but I just use it as an example to show that labor costs can vary. Delivery fees count as selling costs also, and you should look separately at those delivery costs and keep them separate so that you can decide if you should be doing the deliveries yourself or if it's something that you can hire it out. Ultimately, the goal is to be able to know what the cost and the sales income is for each department, if not each product. In a low-margin business like a food hub, you need to know costs and income for each department so that you can effectively price what you're selling, or perhaps even stop selling a product line if you know you're losing money on it.
So when we get into looking at things by department, we'll want to look at things like the sales of proteins compared to the cost of proteins, the sales of produce compared to the cost of produce. And this works universally, whether you're purchasing these things for resale, you're producing them, you're simply processing them, or even if you're brokering them, you need to know what percentage each of those are contributing to cover overhead and profit. From there, right, you'll figure the gross margin once you have those numbers. We'll go through how to do that in just a bit. You'll want to know, is this product carrying its own weight so that you can decide how much of your limited space you're going to allocate to each of these product lines. Because if you're carrying something that's very low margin and not earning a very good return, if that's part of your mission, that's fantastic. But you're going to need something to pick up the slack. And knowing exactly what each is contributing is going to help you make the decisions on what to allocate, what fits.
So there's some things to be careful of. You know, in the end, it's pretty easy to just toss all of the income that you get into one category of sales. But I think that's cheating yourself as far as collecting information that will help you make better management decisions. Another common error is to mix and match among different product features or dimensions. It's not that any of these categories are wrong, farmers markets, wholesale, or greens. But if you use all of them, you're sort of measuring three very different things: where it's sold, how it's sold, or what is sold. And if you use all of those categories, you're going to be creating some confusion for yourself. For example, if you sold greens to a wholesale customer at a farmer's market, how exactly are you going to categorize that transaction? The best thing to do is to figure out what one dimension allows you to capture the most accurate cost information and then stick with that. And that's usually going to be what you are selling, so you can track the product, such as greens. And likewise for offsets like discounts, credits, and reimbursements. If you have general categories with these names, you'll lose the detail of knowing that you most frequently give a credit on leafy greens, for instance, which in effect raises the cost of selling that product line. Offsets should be directly related to the income for a particular product line.
So let's go through that example. Here on G&E's Food Hub, we're going to take the produce sales of $823,000 and all of the produce costs, which you see are many because we're looking at different components of the input. But if we pull them out and we look at the produce department performance, we'll see that sales less costs give us a gross margin. And what we want to look at also is that gross margin, not in terms of dollars. $278,000 are brought in this example, but that's 34% of sales. So is that a good number or is that a bad number? That's what we can benchmark and know not only within our own business in previous years, if we're making improvements or holding steady or losing some margin to erosion, and then how are we doing across the entire industry or within the region? And that's a really fantastic thing to know and a good deal of why we're doing the Food Hub benchmark in the coming year. Now we can do the same thing, and we should with all of our departments. So if we take a look at proteins next, we'll see that we bring in $143,000 and it costs us $132,000 to do that. Now that's $11,000, which is still available to cover overhead and profit, so it's contributing something. But for all the risk we took to sell that amount of protein, we're only earning 8% margin to cover those extra costs. So is that worth it? What if both of these were taking up the same amount of space in the warehouse? Does that make sense? Knowing these numbers helps you ask better questions and then make decisions that contribute to your bottom line.
So overhead is frequently confusing. I like to think of it as those costs which allow you to open the door. You've got the basic dirty five: depreciation, interest, repairs, taxes, insurance. And those other costs are things that you have to spread out over the course of a whole year on top of the sales that you make. So in essence, whether you make one delivery from your Food Hub a year, or you make 1,000 deliveries, you're going to have overhead costs that are going to be about the same, because those other factors like administrative labor, the bookkeeper or the accounting person in your office, or the marketing people or the professional fees such as an accountant or lawyer, are all going to be there no matter how much stuff you sell. No matter how much stuff you sell, your rent and utilities are going to be about the same. May go up a little bit for utilities, but thinking of overhead as costs that whether you sell one delivery or 1,000 deliveries, you still are going to incur these overhead costs, and you're going to have to spread them over whatever your total sales are.
So when we put it all together, we see an income statement with income at the top by department, cost of those products, again by department. Our selling costs are separate, and that gives us a gross margin. It leads then to our overhead expenses, and finally our net operating margin, which is referred to as the bottom line. Now this is the detail of a 5-line income statement, and you're getting some pretty darn good information here. But one thing you'll notice you don't see is a lot of the little categories, the accounts that you often see like dues, subscriptions, licenses, permits, and those kinds of things. While it's important to track where all your money goes, most of those things are not urgent, as in you don't need to be looking at them every day, and they don't need to be cluttering your income statement or causing you to have pages and pages of information that's not going to help you make a better management decision. So you'll find things like that under other expenses, the last line of overhead. You can dive into the detail as necessary, but you really don't need to see that. For instance, in Connecticut, I paid the same $250 LLC tax as I did last year and the year before and the year before that. A lot of folks drive towards those because those are the tax lines, but you really don't need that information on a daily basis.
So what we suggest you do need on a daily basis is an understanding of this 5-line income statement for your food hub. For Aaron and my food hub, this is how it works out using numbers, as well as comparing it to as a percentage of sales. Again, using a comparison to percentage of sales allows you to compare your results to the benchmarking results and gives you an idea of how well you're performing against other food hubs. Now, if you take the selling costs out and separate them out, that's another healthy step to do, because selling costs are a fairly large percent of your food hub business, and you need to know that and be able to compare that those selling costs in a benchmark also. It's harder to do. It's another step, but if you can do it, it's another way to give yourself just that little bit more information on a very simple income statement, so that you can focus on what levers you need to pull as far as management. Should you increase the labor amount that you spend for selling costs in order to try to gain more sales volume? There are many ways that this sort of information can help you make better decisions as a manager.
And even on a simple level, a merchant fee, the cost of doing business with credit cards is a selling cost. But if you have that buried in bank fees that you never look at, that's not going to be real handy. Having it separated out into selling costs allows you to know when it's time to go renegotiate with your provider.
So what's in it for you to track separately as far as these other income and other expenses? It's not the main business of your food hub, but you have to consider that keeping it separate allows you not to distort the operational performance of your food hub on your income statement. All of these things, like grants or contributions, might not be there next year. You can't count on them. And so you don't want to distort the margin that you get from the rest of your operation by sort of burying these other income and other expenses into your management profit and loss statement. So for instance, if you're making salsa and buying the tomatoes that you produce at a reduced cost, you're not really looking at the true cost to that enterprise of making salsa, because you're in fact giving yourself a discount on the tomatoes because you grew them yourself. Now, you may want to do that, but it does not reflect the true cost of making that salsa. So the more focused your income statement is on operations, really in the end, the more you can manage those operations. And that's the big caution about other income and other expenses, is to make sure that they're separate from your core business so they don't distort the bigger picture of how you make money in the food hub.
And the bottom line is the one that, whether or not we're focused on immediately, is the one we should be. So we've got two different things to look at here. One, the net operating margin, which looks at income from operations less expenses from operations, which is what we went through on the profit and loss. And then there's the overall net margin, which is calculated after your operating margin and those other things Gary just talked about: other income, other expenses, grants, contributions, programs, etc. We want to separate these two so that we know what is the going concern driving, and it's a more reliable indication of what is the capacity for this business to take on new debt. However, it's important to know that all of those other things do contribute to the overall bottom line of the hub for a particular year, so we do want to make sure that we have a measure of that as well.
So your income statement is a management document, and your tax return is for compliance. I have to point out that the IRS does not publish Schedule C or Schedule F, if you're a farmer, as a recipe for how to make money in your food hub business. They're into compliance, and it's for paying taxes. Your income statement is yours, and it should be organized so that you can manage your business. It can be easier to just look at income in and expenses out, but that is not the true picture, and your tax return tends to distort the true picture of your business. So the role of your tax preparer is compliance with the law, and you certainly want to do that. But the management parts of all of the layers of information that Aaron and I have been talking about are essentially missing from your tax return. And that's okay, because it's not a recipe for how to make money. It's reporting your income so that you can pay taxes.
So what Gary's saying in not so many words is you don't have to have a chart of accounts that matches your tax return. That's what you pay your accountant for, to put it on the right line. And in doing so, we need to keep in mind that there are two different kinds of accounting: cash basis, which most small businesses are allowed to use. And under this system, you record income when you receive it, and expenses are considered expenses when you pay for them. Now that's different from the accrual basis, which is most common around the world, where you record income when you earn it, and you record expenses when you incur them, no matter when cash changes hands. And the reason you look at this accrual method is because, as Gary said, it's a much clearer picture of how the business is actually performing. If you do something in December that you don't get paid for until January, well, that's really income in the previous year that you need to consider. So in order to figure this out, you need to make sure that you have an accurate balance sheet at the beginning of the year and at the end of the year so you can look at the changes. So real quick, we're going to take a look at 3 examples. There are 6 items that you need to do this with: accounts receivable, prepaid, accounts payable, but you would also want to do this for inventory, supplies, and accrued expenses. So we're going to look at this for the 3 highlighted ones. Accounts receivable went up from $8,000 to $65,000. And if we're going to match the income in the year it was earned, it really was earned in 2016, we just hadn't been paid for it yet. So we need to add $57,000 of income to our 2016 year. If we go to the gray, which is the prepaid, we see that they went down, meaning we used up that prepaid asset and we need to add expense to our income statement. If we move to the yellow, the current liabilities, we see that our accounts payable went up, meaning we used those products, we just haven't paid for them yet, so we need to include that expense in our year as well. Now we also need to know what these things were for. For the prepaid expenses, if we go and look in our detail and find out it was for rent, that's a really good thing to know because you can't deduct for taxes prepaid rent. So you certainly want to keep an eye on that one and not prepay it too far. And the accounts receivable and payable, when we look at that, what if they were for proteins? Do you remember how poorly the proteins were performing on a margin basis before? Well, if we look at the protein sales and the protein costs, and we adjust for the accrual version, we're going to add those $57,000 of income from the accounts receivable that we didn't count before. And we're going to add the $7,000 of expenses that we hadn't included yet. And look at the total. We now have $200,000 in protein sales, $139,000 in protein costs to deliver that product, which means we actually made $61,000 on proteins for a 30% gross margin. That's a pretty big change from the 8% we were looking at before. And I think I would make a very different decision about the future of this department in my food hub, knowing those 2 different numbers. In fact, I would also be able to tell you that as this accrual earnings show, 30% gross margin is pretty darn good for proteins. So I would definitely keep that department at this point, unless I'd been able to do a whole lot better in the past. So knowing where you stand and what the true performance of the department is can lead you to a very different decision. So you want to make sure you've got all the information at hand.
All right. Well, that's all that we're going to talk about new today. But I suggest, once again, we'll have a contest with prizes. And rather than homework, this is business work. If you can review your profit and loss statement and put it in the 5-line format as shown on slide 14, which will calculate your gross margin, you can send those results with your actual numbers and by percentage, if you can do that, by percentage of sales. Send that to me at madison@fccouncil.com by 8 a.m. on Thursday, which is the morning of our office hours. And We're asking you to do this as an assignment, not to torture you like your 5th grade teacher, but rather this is good for you. You know, we're kind of being doing an eat your vegetables sort of play here, that this is good for you. You need to figure out how to simplify your profit and loss statement so that you can look at it as a manager would, and then build back up to detail as you can do that in the future. So take a shot at it. If you are among the correct, if you have accomplished this information, and email it to me, we'll select from 3 winners and send each of you a hat and a chicken USB drive as a way to say thanks for putting in the effort to make your Food Hub run better.
Okay, we are at the bottom of the hour now, so I am going to collect all of the questions that have been asked, some fantastic ones, and I am going to present those early on on Thursday's webinar, the office hours, as we're calling it. So at this point, I just want to thank Aaron and Gary. Let me put up the full schedule of the webinar series. Thursday we'll do office hours for the income statement / profit and loss statement, and then on the following Tuesday we will get into our next lecture on the cash flow statement. So you can go find the recordings, ngfn.org/hubfinances. There's a link to the recordings from there. I will attempt to post this recording either later today or tomorrow morning. I'm trying to really get them up as quickly as possible. Okay, please contact us at any time. Our email address is contact@ngfn.org. We're on Twitter, YouTube, and our website, ngfn.org. And just let me just remind you that after this webinar, there will be a post-webinar survey. Should be quick, but really helps us to improve our stuff. So give us some feedback. All right, thank you, and we'll talk to you on Thursday. Bye-bye.